Right now, the market is closed. Opendoor Technologies, ticker OPEN, finished the last trading session on Thursday, November 6, 2025 at $6.56. That was flat for the day, 0.00% change, but that single number hides the story. The stock actually traded as high as $7.37 and as low as $6.52 during the session, on massive volume of over 18 million shares. That kind of volatility tells you there is a war happening between buyers and sellers. And what's fascinating is that the closing price is sitting right in the middle of a battle that's become more than just about housing. The company just made a move that nobody was expecting, announcing a special dividend of tradable warrants. This isn't a simple cash payout. It's a complex financial instrument, a bet on the company's own future, with exercise prices set at $9, $13, and even $17 a share. For a stock that analysts have slapped with $1 price targets, this is a defiant, almost aggressive signal from management that they believe Wall Street is fundamentally wrong. The general expectation for Opendoor has been, to put it mildly, disastrous. This was the poster child for the iBuying model, a tech-powered instant buyer of homes. The narrative was simple: use algorithms to buy homes, perform light repairs, and resell for a profit, all at scale. Then the music stopped. Interest rates shot up, the housing market froze, and Opendoor was left holding a massive inventory of homes that were losing value by the day. The consensus view became that Opendoor was a failed SPAC, a glorified, capital-intensive house flipper that was burning cash and was functionally insolvent, just waiting for the housing market to deliver the final blow. You can see this sentiment reflected in the analyst ratings. In August, Keefe, Bruyette & Woods downgraded the stock to underperform with a $1 target. Zelman & Associates did the same. Citigroup went even further, branding it a sell with a 70-cent target. The expectation became that this was a race to zero. But the reality of what's happening right now is far more complex. The company just delivered its third-quarter earnings, and it was a perfect snapshot of this expectation versus reality tension. Revenue came in at $915 million, which actually beat estimates, but the adjusted earnings per share and EBITDA both missed. So, while they sold more, they lost more on the bottom line than analysts expected. That's the exact data the bears wanted to see. However, the real story wasn't in those numbers. It was in the conference call. The new CEO, Khosrow Nedjatan, essentially announced a refounding of the company. He's aggressively pushing Opendoor away from being just a flipper and reframing it as a tech and AI company. He spoke of eliminating reliance on consultants and launching new AI-powered products that have, he claims, reduced the manual work for a home contract from needing 11 employees down to just 1. He also announced a new financial open house format for earnings, a clear signal that he's taking his case directly to the retail investors who have stuck with the stock, bypassing the skeptical Wall Street analysts. This is the new bull case, that Opendoor 2.0 is a lean, tech-first marketplace, and the Q3 numbers are the last echo of the old capital-heavy model. The warrant dividend is the exclamation point on that, a way for management to say, if we hit on goals, this stock won't be at $7, it will be at $17, and we want our long-term shareholders to benefit. This all comes at a time when the macroeconomic picture remains a massive headwind. Mortgage rates are holding steady at around 6.15%. That is toxic for any business that relies on housing transactions. It keeps buyers on the sidelines and sellers locked into their current lower-rate mortgages. This is why the recent stock movement is so frantic. That spike to $7.37 on Thursday was likely a mix of people buying into the new AI narrative and the excitement over the warrants, but it was slammed back down to $6.56 by sellers and short sellers who believe that no amount of AI can fight the Federal Reserve and a frozen housing market. The 52-week range, from 51 cents to $10.87, tells you this stock is a battleground. It's not a business, it's a bet on a turnaround. Now, we have to talk about the short interest. This is without a doubt one of the most critical factors driving Opendoor's stock price, and the data is pulling in two different directions. The headline number is massive. The short interest is nearly 23% of the entire float. That means for every 4 shares available to trade, one of them is a short-sold share. That is a huge, concentrated bet that the stock is going down. This is the kind of number that gets retail investors on Reddit and X excited about a potential squeeze. The thesis for the shorts is simple and clear. They look at the analyst downgrades to $1, they look at the negative EBITDA, they look at the 6% mortgage rates, and they conclude that the company is a walking zombie. They believe the AI refounding is just corporate jargon to distract from the fact that the company is burning cash and its business model is broken in a high-rate environment. But here is where you need to look closer at the data, and this is the actionable part. When investors hunt for a short squeeze, they look at 2 key metrics besides the short float: the days to cover and the cost to borrow. Opendoor's days to cover is only about 1.6. That's low. Because the stock trades with such high volume, it would only take shorts about 1.5 days to cover their entire position. This isn't like a stock with low volume, where they would be trapped. The second and most important metric is the cost to borrow. This is the interest rate shorts have to pay to borrow the shares. For Opendoor, that rate is currently a tiny 0.66%. That is practically free. This is a very bearish signal. It means that large institutions, the ones who own millions of shares, are more than happy to lend them out to short sellers, likely because they either agree with the short thesis or want to hedge their own positions. It means there is no scarcity of shares to short. So, while the 23% short float is explosive, the underlying metrics suggest the shorts are not in a panic. They're comfortable. However, there's a third piece of data. On one of the last trading days, the short volume spiked, with a reported 97% increase, representing over 8 million new shares shorted in a single day. This is an active attack. This isn't a passive bet. This is someone aggressively adding to their short position, trying to push the price down. This is where you see the talk of fails to deliver, or FTDs, come up. An FTD is when a seller, often a short seller, fails to deliver the shares they sold on the settlement date. You can track this data directly on the SEC's website. While FTDs can happen for many clerical reasons, a consistent high number of FTDs in a stock with high short interest can sometimes suggest that not all is as it seems, and shares are becoming difficult to locate. It's a key piece of data for anyone watching this for a squeeze. What's your take on this short data? Is the low borrow rate the real story, or is that massive 23% float the only thing that matters? Let me know in the comments. This fight is perfectly reflected in the institutional ownership. The data from the last quarter's F13 filings shows a massive, clear-as-day rotation. The old guard is out. BlackRock sold over 35 million shares, a 70% reduction in their position. Vanguard sold nearly 20 million shares. State Street dumped almost 65% of its holdings. This is the smart money, the big conservative pension funds, and they have run for the exits. But at the same time, a new group has rushed in: quant funds. 2 Sigma Advisors, Cube Research Management, Veriton Fund Management. These are firms that live and die by algorithms and high-speed data. They all initiated massive new positions. This tells you the stock is no longer a buy-and-hold investment. It has become a pure trading vehicle. It's a proxy for volatility, a number in an algorithm, being traded back and forth by some of the most sophisticated quantitative funds in the world, fighting over pennies while retail investors are holding on for the big turnaround. So, what does Opendoor actually do? At its core, it's an iBuyer. You go to their website, you type in your address, and they give you a cash offer for your home, usually within 24 hours. If you accept, they buy your house, fix the leaky tap, paint the walls, and then list it for sale on the open market. They make their profit from a service fee, typically around 5%, and any appreciation in the home's value. The problem, of course, is that they're exposed to all the risk. If the housing market turns, they're left holding thousands of homes. This is what the new CEO is trying to fix. The Opendoor 2.0 vision is to be less of a home flipper and more of a real estate marketplace. They want to use their software and data to partner with agents, to offer mortgages, to sell title insurance, and to create a one-stop shop, taking a cut of every part of the transaction without having to take on the risk of holding the house on their own balance sheet. This is the only path to a sustainable high-margin future. Comment below if you think Opendoor can actually become an AI company or if they are just